Hello everyone, I'm Aaron Blake. Spot silver prices collapsed by an extraordinary 37% in a single day on Friday, January 30th, marking the largest one-day fall on record, and the scale of this move has sent shockwaves across global markets. Futures plunged 31%, silver-linked exchange-traded funds saw historic losses, and what had been a powerful rally suddenly reversed in dramatic fashion. This matters right now because the forces behind this crash go directly to interest rates, the US dollar, and market positioning, all of which shape how capital moves in moments of stress. Before we go further, subscribe right now because what you're about to hear explains a shift most people still haven't noticed. To understand what happened, we need to start with the sheer magnitude of the move. Earlier this week, spot silver prices were touching record levels above $120. That rally had been building over time, driven by a specific set of market concerns and expectations. But on Friday night, that momentum broke decisively. In a single trading session, spot prices plunged to $84. That is a collapse of 37% in one day, the biggest single-day fall silver has ever recorded. Futures markets echoed the move, with contracts plunging 31%, marking the worst fall since March of 1980. These are not routine fluctuations. These are extreme historic price movements that demand close attention. The damage extended far beyond the spot market. In the United States, silver-linked exchange-traded funds experienced even more severe stress. The ProShares Ultra Silver ETF saw its price crash by 60% in a single trading session. The iShares Silver Trust ETF plunged 29%. For both of these funds, Friday marked the worst day on record. These moves reflect not just falling silver prices, but also the rapid unwinding of leveraged and speculative positions as the market turned sharply lower. What stands out here is that this sell-off was not driven by a single headline or a single trade. Multiple factors contributed to the collapse seen overnight. Among them, three forces were central to the reversal, and together they explain why silver moved so violently, so quickly. The first of these forces revolves around U.S. monetary policy, and more specifically, the leadership of the Federal Reserve. An important part of the rally in precious metals through 2025 and into January had been concerns surrounding the independence of the U.S. Federal Reserve. Those concerns intensified as U.S. President Donald Trump repeatedly demanded lower interest rates and publicly criticized outgoing Fed Chair Jerome Powell. Trump indicated multiple times that Powell could be fired, and that uncertainty fed into broader market anxiety about how monetary policy decisions might be made going forward. Until last week, speculation had centered on White House National Economic Council Director Kevin Hassett as the likely choice for the top job at the Federal Reserve. Markets believed that Hassett would be more aligned with the White House's push for lower interest rates. That expectation supported precious metals because lower rates reduce the opportunity cost of holding assets like gold and silver, which do not pay interest. However, on Friday, President Trump made a different choice. He nominated former Fed Governor Kevin Warsh as the new Federal Reserve Chair. Warsh is known for advocating central bank independence when it comes to setting policy. He is also widely described as an inflation hawk. This appointment immediately changed how markets viewed the near-term outlook for monetary policy and the independence of the Fed. Let me explain what this means. Warsh's nomination eased some of the immediate concerns about political pressure on the Federal Reserve. In the short term, that reduction in fear is indirectly negative for precious metals such as gold and silver. These assets tend to benefit when interest rates are expected to fall because they offer no yield. If rates are not expected to drop as aggressively, or if policy is expected to remain tighter, the relative appeal of holding non-interest-bearing assets diminishes. That shift in expectations removed a key pillar of support that had underpinned the silver rally. This development comes as markets had already priced in a great deal of optimism around lower rates. When Warsh was named, traders were forced to reassess those assumptions rapidly. That reassessment played out almost immediately in prices. The second major factor behind the silver crash was the US dollar. Throughout January, a weaker U.S. dollar had contributed to rising prices in gold and silver. President Trump's remarks expressing a preference for a weaker currency also added to that dynamic. A softer dollar tends to support precious metals because they are priced globally in U.S. dollars. When the dollar falls, metals become cheaper for foreign buyers, boosting demand. But once again, Warsh's appointment changed the picture. Following the nomination, the U.S. dollar staged a sharp reversal. In fact, it recorded its biggest single-day gain since May of last year. The U.S. dollar index climbed back above the level of 97 as fears surrounding the Federal Reserve's independence eased. Here's what the data shows. A stronger dollar is typically negative for gold and silver. Because these metals are priced in U.S. dollars worldwide, a rising dollar makes them more expensive for buyers using other currencies. That tends to reduce demand. At the same time, expectations of higher interest rates further reduce the appeal of non-interest yielding assets like silver. The combined effect of a stronger dollar and shifting rate expectations created significant downward pressure on prices. The timing timing of this dollar move is critical. It arrived precisely as silver prices were sitting at extreme levels after a rapid rally. That meant the market was particularly vulnerable to a sharp reversal once sentiment changed. The third major driver of Friday's collapse was technical. There were several technical triggers that accelerated the fall once it began. First, momentum indicators were flashing warning signs. The Relative Strength Index, or RSI, on both gold and silver charts had moved deep into overbought territory. A reading above 70 indicates that an asset is overbought. For silver, the RSI had tested levels above 80 during the record rally. That signaled that prices had moved too far, too fast. In this environment, money managers were already looking to take profits. U.S. government data released on Friday showed that hedge funds and other large speculators reduced their net long positions in silver by 36%, bringing them down to 7,294 contracts for the week ending January 27th. That marked the lowest level in 23 months. This reduction in positioning suggests that large players were already stepping back before the most dramatic part of the sell-off unfolded. Once prices began to fall, additional technical pressures came into play. Increases in margin requirements for trading, the forced liquidation of speculative positions, and profit booking by investors likely accelerated the decline. As prices broke lower, automated trading strategies and stop-loss orders would have been triggered, adding further momentum to the move. Christopher Wong of Overseas Chinese Banking Corp captured this dynamic in a note, writing that Warsh's nomination was like one of those excuses markets are waiting for to unwind those parabolic moves. That phrase reflects how markets sometimes behave after sharp rallies. When prices rise quickly, they can remain elevated until a catalyst appears. Once it does, the unwinding can be swift and severe. Commerzbank AG echoed this view, noting that the extent of the correction suggests market participants were simply waiting for an opportunity to take profits after the rapid price rise. At the same time, Commerzbank said that while Warsh's appointment may have eased some independence fears, the Federal Reserve will still yield to pressure to some extent and cut interest rates more than is currently being priced in. That assessment highlights the tension now facing markets as they recalibrate expectations. As silver prices collapsed, the technical damage became more pronounced. The fall took silver below all major moving averages, a signal closely watched by traders. Dominic Sperzel, head of trading at Heraeus Precious Metals, summed up the situation by saying that markets need to prepare for the roller coaster to continue. That comment underscores the level of volatility now embedded in the market. Now let's step back and look at why this sequence of events matters so much. Silver's record one-day fall is not just about one metal. It reflects how sensitive markets have become to changes in expectations around interest rates, central bank independence, and currency strength. In a matter of hours, a narrative that had supported higher prices unraveled. What stands out here is the speed. Silver moved from record highs to a historic crash in a single session. That tells us that positioning was crowded, sentiment was stretched, and the market was primed for a reversal. When Warsh was nominated, it altered assumptions around the Federal Reserve just enough to trigger that reversal. The reaction in the US dollar reinforces this point. The dollar's biggest single-day gain since May of last year shows how quickly capital can shift when confidence changes. As the dollar strengthened, the pressure on silver intensified. This relationship between the dollar and precious metals remains a critical channel through which policy expectations affect prices. The technical backdrop amplified everything. Overbought conditions, declining speculative positions, higher margin requirements, and forced liquidations all fed into the sell-off. Once prices started falling, these factors did not operate in isolation. They reinforced each other, turning a correction into a collapse. For investors and market participants, this episode highlights how interconnected these forces are. A decision about who leads the Federal Reserve can ripple through currency markets, interest rate expectations, and commodity prices almost instantly. When those ripples hit a market that is already stretched, the result can be dramatic. As we move toward the close, it's important to recap what is confirmed. Spot silver prices plunged 37% on Friday, January 30th, the biggest one-day fall on record. Futures fell 31%, the worst since March 1980. Silver-linked ETFs in the United States suffered historic losses, with the ProShares Ultra Silver ETF down 60% and the iShares Silver Trust ETF down 29%. Three main factors drove the sell-off. The nomination of Kevin Warsh as Federal Reserve Chair eased concerns about central bank independence and reduced expectations for aggressively lower interest rates. The U.S. dollar surged, posting its biggest single-day gain since May of last year, and moving back above 97 on the dollar index. Technical factors including overbought conditions, reduced speculative positioning, margin changes, and forced liquidations accelerated the decline. Silver's fall pushed it below key moving averages, reinforcing the sense that volatility is likely to remain elevated. As Dominic Spurtzell warned, the roller coaster may not be over. This is a reminder of how quickly markets can turn and why understanding the forces at play is essential in moments like this. Thanks for watching. Subscribe, share this video, and stay alert, because what's happening right now matters more than most people realize.